You've done the work. You found the perfect technical setup, set your entry, placed your stop loss, and sat back. Then, in a fraction of a second, your glowing profit line explodes into a chaotic blur of red. This violence stems from a highly scheduled economic news release, a fundamental event that caught you off guard. For experienced traders, the Forex economic calendar is an absolute necessity. Think of it as a financial weather forecast that tracks incoming, high-volatility market storms. By learning to read this calendar, you stop getting blindsided by sudden price spikes and start using that exact same volatility as the fuel for your next trade. Strip away low-impact surveys and focus strictly on red flag events, like the Consumer Price Index and non-farm payrolls. When this data shows rising prices or a tightening labor market, it signals the central bank to pull the interest rate lever upward. That resulting policy decision, made inside institutions like the U.S. Federal Reserve, is what ultimately dictates the strength or weakness of a global currency. Tracking these specific economic indicators allows you to anticipate the central bank's next monetary move before they even make it. Look closely at any major calendar listing, and you'll find three numbers. You have the previous data, the forecast made by analysts, and the actual official number. Long before the release time hits, the global market has already positioned its capital based on that forecast. The expected outcome is already baked into the current price of the currency. This graphic illustrates the engine behind price action, the surprise. The market moves rapidly to reconcile the measurable gap between the expected forecast and the reality of the actual number. When that gap opens, traders are scrambling to reprice their positions because their collective expectation was proving wrong. At the precise second a major data surprise hits the wires, institutional algorithms take total control of the market. During a high-impact release, buy and sell blocks evaporate as major players pull orders, creating a massive liquidity gap. Without liquidity, a plunging market bypasses your stop-loss line and executes your trade at the next available price. This is slippage. Warning tone. That massive initial candle is a mechanical trap. It is driven purely by algorithmic panic, making the exact moment of the release the worst possible time to enter a position. You protect your capital by actively sidestepping the shockwave. In the minutes before a major release, cut your open position sizes in half or simply move your stop loss up to your break-even entry point. Once the data drops, let the initial whipsaw happen. Professional traders sit on their hands, wait for the first 30 minutes, allowing algorithmic chaos to burn out. Once volatility settles and price pushes through a major resistance level, don't chase the breakout. Instead, wait for price to curve down and retest the broken line for a safer entry. Consistent returns rely on avoiding the unpredictable spike entirely. You want to exploit the clean, technical clarity that the news leaves behind after the dust settles. Combining your technical analysis with a strict calendar schedule strips the emotion out of the event. It elevates you from guessing outcomes to executing calculated plans. Head to the FXNX platform today to track these upcoming economic events. You can put these post-release retest strategies into action safely using an FXNX demo account. When you understand the mechanics of a market shock, you no longer have to dread the headlines. You can use them to your advantage.